brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth.
Bueno, pues de momento Jerome Powell explicando los motivos por los que la Reserva Federal ha decidido mantener esos tipos de interés en el 5,25, 5,5%. Ha dicho Jerome Powell que están muy atentos a los últimos datos que se acaban de conocer, que están demostrando que hay resiliencia económica y que hay demanda laboral. Lo ha dicho, hay mucha demanda laboral. Dice que esto podría poner el progreso de la inflación en el futuro en riesgo. Jerome Powell ha insistido, hablando de que están comprometidos para conseguir un enfoque restrictivo, suficientemente restrictivo. Habla de que también su política monetaria restrictiva está poniendo una presión a la baja en la inflación, por lo tanto reconoce que la Reserva Federal está realmente impactando sobre la inflación. Sus subidas de tipos funcionan para que la inflación baje y dice todavía hay un largo camino hasta que la inflación llegue al 2%. Powell además también ha insistido en que van a mantener una política monetaria suficientemente restrictiva hasta que estén confiados de que la tendencia de la inflación es claramente a la baja, y ha insistido también en que todavía la inflación está muy alta y que respecto a las expectativas de inflación a largo plazo, de momento se mantienen bien ancladas, algo que sería positivo para que la inflación siga bajando. Seguimos escuchando a Powell todavía en su discurso inicial.
Committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. Second thing is that the longer term rates that have moved up, they can't simply be a reflection of expected policy moves from us that if we didn't follow through on them, then the rates would come back down. So and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So in the meantime, though, perhaps the most important thing is that these higher treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a
Bueno, pues Jerome Powell acaba de decir que todavía no se han decidido futuras decisiones de cara a las próximas reuniones. Por lo tanto, no quiere tampoco dar a entender al mercado que van a seguir subiendo los tipos. De hecho, todavía no hemos escuchado una amenaza suficientemente férrea por parte del presidente de la Reserva Federal diciendo que aunque hayan pausado, podrían seguir subiendo. Esto de momento no lo ha dicho y dice, todavía no hemos decidido nada sobre las próximas reuniones. Puede ser que este sea un cambio en el tono de Jerome Powell, que no quiere seguir amenazando al mercado y que simplemente se mantiene diciendo que no saben muy bien qué van a hacer. Vamos a seguir escuchando.
I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So let me start by saying we haven't made a decision about September. You're asking a hypothetical there, but we're going into this December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity, and so we'll be taking, and also the broader situation, the broader financial conditions situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say, though, that the idea that the idea that you would be difficult to raise again after stopping for a meeting or 2 is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did.
Bueno, pues Jerome Powell ahora respondiendo sobre la recesión, sobre si puede haber o no recesión, pero importante sobre todo lo que ha dicho justo antes. Le han preguntado sobre próximas futuras subidas de tipos de interés y atención a lo que ha dicho, será difícil volver a subir los tipos después de pausar. Probablemente sea una de las frases o de los momentos en los que Jerome Powell ha sido más claro sobre su no amenaza de próximas subidas de tipos. Powell dice, será difícil volver a subir los tipos después de pausarlos. Desde luego, una manera muy clara de sugerirle al mercado que podría no haber más subidas de tipos de momento, porque considera que las condiciones actuales financieras, que lo ha dicho y lo ha insistido ahora con los tipos de los bonos, con el dólar tan fuerte, que las condiciones financieras y las de crédito ya son suficientemente restrictivas, pero eso sí dice que no sabe si de momento están en un momento suficientemente restrictivo en general en su política monetaria como para empezar a ir retirándola. Seguimos escuchando a Powell hablar de recesión y parece que le están haciendo otra pregunta.
Growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far.
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Colby. Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture. and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? Are we looking at that? Growth, we look at growth insofar as it has implications for our 2 mandate goals. We look at that, and we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike.
Bueno, pues Powell, por un lado, ha dicho que considera que es difícil que después de pausar la subida de tipos en una o 2 reuniones, que en este caso ya han sido 2 reuniones, cree que es difícil que vuelvan a subir los tipos de interés. Pero eso sí, dice, si vemos que la economía sigue siendo muy resiliente, si vemos que la inflación sigue subiendo y que el mercado laboral tampoco se empieza a enfriar, si consideramos o llegamos al argumento que nos invita a pensar que hay que subir los tipos de interés, los vamos a subir. Pero además también le han preguntado por bajadas de tipos. Eso sí, Powell coincide totalmente con Lagarde. Ni piensan ni hablan de bajadas de tipos de interés en la Reserva Federal. Seguimos escuchándole.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking: is should we hike more? It's not, and that is the question. And you're right that in September we wrote down 1 additional rate hike, but we'll write down another forecast, as you know, in December.
Chris.
Thank you, Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers' strike has finished. Oil prices have leveled off, and yet on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there, as you point out. Global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation. And we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you pick up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together. in the face of, some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear, and is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even, just thinking that we really the best thing we can do for the U.S. is to restore price stability, fully restore price stability, and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side gain that is really helping the economy, and it's part of why GDP is so high, is because we're getting that supply. So we welcome that, but I think those things will...
Bueno, le han preguntado a Powell por una de las declaraciones que hizo anteriormente, asegurando que todavía teníamos que ver daño en la economía de Estados Unidos para que la inflación siguiera cayendo. En este sentido, muy interesante lo que está diciendo Powell. Dice: yo por lo menos creo, y muchos de mis colegas creemos, que sigue siendo verdad el hecho de que la inflación, para seguir cayendo, necesita de un menor crecimiento que el que estamos viendo ahora. Por lo tanto, Powell no se acaba de creer esto de que ahora estemos en una nueva era económica, donde un ciclo de subidas de tipos tan importante y tan rápido como el que hemos visto hasta ahora pueda realmente salir un poco de rositas, ¿no? E irse de rositas sin que afecte a la economía y sin que afecte al mercado laboral. Cree que eso puede no ser del todo cierto y que al final acabaremos viendo menos crecimiento en la economía de Estados Unidos por culpa de las subidas de tipos de interés. Por lo tanto, Powell cambia ese discurso. En lugar de decir que espera un daño en la economía, simplemente habla de menor crecimiento, que cree que eso sigue siendo algo que puede ocurrir de cara al futuro. Seguimos escuchando a Powell.
I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plots out the window, that every meeting is live with the possibility of a rate increase for right now. It doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people on the committee thinks is likely to be an appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change. For example, I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is, what's potential growth this year? People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration.
Pues Jerome Powell ahora está respondiendo a una pregunta relativamente interesante, ¿no? Sobre ese diagrama de puntos, ese dot plot de la Reserva Federal, donde los miembros de la Fed nos dicen qué creen que tiene que ocurrir en las próximas reuniones, cuántas subidas de tipos quedan. Saben que, en teoría, según el último dot plot, quedaría una subida más de tipos de interés. Bueno, pues le han preguntado por esto a Powell, porque está insistiendo en que al final es una decisión que se toma subjetivamente en función de los datos que van saliendo para cada reunión. Claro, lo que dice aquí Jerome Powell, lo que sugiere más bien es que ese dot plot realmente no tiene mucha validez. Dice, no representa ningún plan de la Reserva Federal, es simplemente un pronóstico que puede cambiar de aquí a 6 semanas, decía él, por ejemplo. Porque en esas 6 semanas puede haber un cambio en los datos que han llegado y que ha estado observando la Reserva Federal, y por lo tanto alguien que ha pensado que todavía queda una subida más de tipos ahora puede pensar que no queda ninguna subida más de tipos de interés. Por lo tanto, parece que Powell está restándole validez a ese dot plot que publica la Reserva Federal cada 3 meses, que va a publicar, por cierto, en el mes de diciembre, y que veremos aquí, en este sentido, qué es lo que nos transmite, aunque dice Powell que es solo un pronóstico.
We've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think 1 or 2 additional hikes. So you're close to the end of the cycle. That was an impression, as of a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully, because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up. And QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not, I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. What I do expect.
Bueno, pues a Powell ahora le han preguntado también por ese QT, ese quantitative tightening, esa reducción del balance de la Reserva Federal. Bueno, en este sentido dice que la Fed no está considerando cambiar el ritmo de reducción del balance. Ha insistido también en que hay muchas razones que pueden explicar por qué los tipos de los bonos a largo plazo han subido de la manera en la que han subido en las últimas semanas, y dice que probablemente el QT no sea realmente una de las grandes razones por las que eso ha ocurrido. También ha hablado de las reservas en dólares, de los 3,3 billones de reservas en dólares, y dice que no es algo en lo que realmente estén fijándose como explicación del movimiento en los tipos de interés de los bonos a largo plazo. Más preguntas para Powell.
Banking stress.
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but there are a few of the common ones that people look at. And so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture, and they do play a role, of course, in many of the major standard financial condition indexes. Your second question was banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both debit and credit cards in the payment system?
So you're right. We put a proposal out for comment is what we did. And this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do.
Pues desde luego que uno de los temas estrella de esta comparecencia está siendo el hecho de que los tipos de interés de los bonos hayan subido tanto, sobre todo en la parte más larga de la curva. Y aquí Powell ha hablado sobre el efecto que podría tener esa subida de los tipos de los bonos en la situación bancaria. Ya saben que precisamente a principios de año tuvimos ese susto de Silicon Valley Bank, de Signature Bank, de First Republic, donde 3 bancos cayeron, 3 bancos colapsaron, entre otros motivos por lo mucho que habían subido esos rendimientos de los bonos, lo mucho que habían bajado los precios de esos bonos y claro, que habían provocado que muchas carteras de muchos bancos realmente estuvieran valoradas muy por debajo del precio que aparecía en libros, probablemente. Bueno, pues claro, ahora han bajado más, han seguido bajando esos bonos, con lo cual, como hay algún banco que esté en una situación crítica, esto puede volver a aflorar. Bueno, pues dice Powell que no tiene motivos la Reserva Federal para pensar que la subida de los tipos de los bonos a largo plazo, puede alterar la situación bancaria. Bueno, Powell es bastante optimista, por lo tanto, con que ese movimiento de los bonos no va a romper nada de momento, por lo menos en el mundo de las entidades financieras, de los bancos. Seguimos escuchando a Powell.
That's sort of consistent with the way inflation comes in. It does take some time, and as you get, as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy. And we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your decision?
Bueno, parece que hay algún problemilla con la conexión, ahora mismo con la señal que nos llega desde la Reserva Federal. Parece que se ha restaurado ya, así que volvemos.
On our portion a little bit, it was actually a preliminary estimate that got revised away, and I said it was preliminary in that, but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. I was curious if you could elaborate on that at all and whether that means the neutral rate in your view has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time. And we know that. So you have to just take that, you have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree